Have you ever really looked at your portfolio and wondered what it's saying about you? Seriously, it's more than just a bunch of numbers and tickers. It's a psychological profile. It shows your hopes, your fears, and your whole game plan for building wealth. All right, let's get into it. This is the big question, isn't it? This is what it all boils down to. Because the line between a smart, strategic investment and just a flat-out gamble, man, it can be paper thin. And it all comes down to the mindset you bring to the table. So, what is this trap we're trying to avoid? The source calls it the gambler mindset. And it's basically when you're so focused on the dream of a massive payout that you completely ignore the actual odds of success. It's when hope and gut feelings totally hijack the part of your brain that's supposed to be doing the math. To really understand this, we've got to get inside the gambler's head. It's a really interesting but, a really dangerous place to be, where a couple of key cognitive biases are running the whole show. And here they are. This slide kind of shows you the vicious cycle that fuels the gambler. It usually kicks off with what's called the lotto fallacy. You're just hunting for that one magic ticket, that 1000x return. And that, of course, leads right into FOMO, right? Chasing stuff that's already skyrocketing. Then, if that bet goes south, this powerful urge for revenge trading kicks in to try and win it all back. And the whole mess is usually propped up by having zero exit strategy, which means you might just ride a bad bet all the way to zero. And this just says it all, doesn't it? This one sentence is the lotto fallacy in its purest form. It perfectly captures that gambler mindset. It's not about a process or a strategy. It's about a single life-altering jackpot. That's not a plan, that's a prayer. Okay, so let's flip the coin here and look at the other side. What does a healthy, productive mindset actually look like? Well, a true investor operates from a place the source calls calculated conviction. And this is a whole different ballgame psychologically. So the most important word on this slide is calculated. This isn't blind faith. It's a strong research-backed belief in huge long-term trends, like the rise of AI. But it's also combined with the discipline to manage your risk and not let emotions like greed or fear call the shots. An investor with this kind of conviction has a few key traits you see here. They're often a technological optimist, right? They're making focused bets on big future ideas like AI. But, and this is a big but, they're also a disciplined risk taker, using something like a core satellite structure to handle those riskier plays. They want to be right and early on new stuff. And the absolute key to it all is strong emotional regulation, which keeps them from ever just going all in on a whim. Okay, so we've talked a lot about the psychology. But how does this stuff actually look when you open up a brokerage account? What does it look like in a real portfolio? Well, let me tell you, the difference is night and day. Okay, first up, the gambler's portfolio. Just look at that. An overwhelming chunk, 70%, is in the riskiest assets you can possibly imagine. This isn't a portfolio built for steady growth. It's a portfolio built for a miracle. It's incredibly fragile. And now, look at the contrast. Here's the investor's portfolio. The huge majority, 75%, is in a solid core of high-quality, established assets. The super high-risk plays, like leveraged ETFs, they're kept in this small, manageable satellite position. This portfolio is built to survive the bumps and compound over the long haul. This side-by-side comparison just makes it painfully clear. I mean, look at the use of leverage. For the investor, it's a small, tactical tool. For the gambler, it's pretty much the entire strategy. The investor is focused on asset quality, while the gambler is focused on social media hype. It really just comes down to control versus chaos. Okay, this is where we have to turn the lens on ourselves. It is so easy to slowly drift from an investor mindset to a gambling one without even noticing it's happening. So what are the red flags you should be looking out for? You have to listen to your own internal monologue. If you hear yourself saying stuff like, I'm down 50%, I'll just buy more to lower my average, you're probably not investing, you're revenge trading. If you find yourself thinking, I have no idea what this company does, but everyone on social media is screaming about it, you've swapped research for hype. And if you ever catch yourself praying, I just need this one to hit, well, that's the ultimate red flag that hope has completely taken over your strategy. So how do you protect yourself from all this? You build a system. A real investor relies on a repeatable process, not on pure luck. These guardrails are designed to keep the logical part of your brain in the driver's seat. These 5 guardrails basically form a system to protect you from your own worst impulses. It's all about creating rules for yourself before you're in an emotional situation. Things like having a cap rule for risky assets or using the sleep test for sizing your positions are just crucial. And number 5 is so important, focusing on expected value. That just means you weigh the potential prize against the actual probability of it happening. $1 million payout sounds awesome, but not if there's a 99.99% chance of it going to zero. We're going to break down a few of the most important of these right now. This right here, this is the absolute heart of disciplined investing. A thesis has actual reasons, fundamental, business-related reasons. Hype is just noise. Before you make any trade, ask yourself, can I write down 3 solid reasons for this that have nothing to do with the price chart or what some random person on social media said? If you can't, you're probably gambling. I love this one because it's so simple but so effective. Are you checking prices in the middle of the night? Are you feeling super anxious about one of your positions? If the answer is yes, it's too big. Period. Your portfolio shouldn't be a source of constant stress. The sleep test is your best friend when it comes to risk management. And this is your weapon against that really destructive urge for revenge trading. When you take a big loss, it triggers the emotional fight or flight part of your brain. Forcing yourself to take a cool down period is like hitting a pause button. It gives your rational mind time to come back online before you make another mistake that could be even worse. So to wrap up all these differences, here's a final checklist for you. Are you playing the long game to compound your wealth, or are you just chasing a short-term jackpot? Do you see a loss as a piece of data, a cost of doing business, or do you see it as a personal failure? Honestly, your answers to these questions will tell you everything you need to know. And this might be the most important takeaway of all. An investor always keeps some cash on the sidelines, what we call dry powder. That cash isn't doing nothing. It's a strategic asset. It's what allows you to look at a market dip not as a terrifying crisis, but as a potential opportunity. At the end of the day, your portfolio is a story. It's a narrative about your relationship with risk, with time, and with your own future. So the final question isn't just about what you own, it's about why you own it. Are you writing a story of discipline's growth or a story of a reckless bet? The choice is always yours.